And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the show. This is Andy Webb with Lifestyles Unlimited. And as always, we're working on your financial freedom. Hey, what do you think if you could create, let's say around $400 a month in extra cash flow to your pocket today to help offset the crazy inflation out there? Would you do it? I bet you would. And what if you could do it by investing in a rental house? This is your way to get there. You invest in a rental house for a really, really low out-of-pocket, unheard of low out-of-pocket. Would you do it? I bet you would. Low out-of-pocket, you're asking. In this era of high home prices and high interest rates, no way. Yeah, you bet. You bet. In fact, I got an email just in the past couple of days from one of the markets where we have the Lifestyles Realty team. I'll get to this a little bit later in more detail, but estimated cash out-of-pocket to get to that $400 on this house is just a little north of $13,000. $13,309. That's what they're projecting based on their numbers. And I'll tell you, historically, they tend to be conservative, these guys. So yeah, you can do that. Create an extra $400 for a very small investment. And we're going to talk about how you get there. We're going to talk about, because when I look at this email, I see that it says estimated out-of-pocket, cash out-of-pocket into this investment using hard money. Okay, so on today's show, I want to talk about financing because this is one of the premier tools in your toolbox if you want to be a real estate investor. So we're going to talk about financing very broadly, and then we're going to dial it in, and I want to talk about using hard money in particular, and how I want you to understand how that particular tool, that financing tool, can help you achieve better returns. And I say better returns in the face of, yes, two things. We'll talk about the process. Why are there two closings? And higher interest, because hard money is a higher interest loan. So you'll have better returns. You're going to use less money to invest, like we just said, $13K out of pocket in this example. And that means you'll be able to do more deals. You'll be able to invest in more houses. So instead of just getting to $400 in cash flow, maybe you take down a second house. Now you're at $800. And you take down a third. Now you're at $1,200. You can keep going, right? Depends on your capital. Depends on your starting point. Depends on your will. You got to push and you got to do these things. And that's actually a very big part of the puzzle, but we'll help you with that. That's what Lifestyles Unlimited does. We are an education and mentoring group. We have the education that helps you understand how to use the tools and give you the toolbox, essentially. And the mentoring side is really what I've tapped into as an investor, a member of Lifestyles Unlimited for over 10 years now, to really, when I'm up against a wall or I'm not sure what to do in a certain situation, I start to have doubts or fears. 10 years later, sure, there are certain things that might get under my skin. Well, I go and talk to those mentors, and they're the ones that help propel me along. If I'm lacking the willpower for some reason, I go to them and they give me that push. So when we talked yesterday on the show about how we make money 5 different ways with our houses. And we talked about how that impacts our net worth. And specifically, we talked about a personal financial statement. And if you missed that show, you can go to lifestylesunlimited.com, click on the radio tab because the shows are archived there. And during the course of that show, we talked about equity capture. And equity capture I love because that's a way of really just creating wealth through the process. And it's really a big piece of that net worth growth. And often we do need that very special tool that I mentioned, that hard money loan, that hard money financing, in order to buy the distressed properties that we target, because they may not qualify for other types of financing. And I'll tell you, again, if you're new to the program, I'm sitting in Dallas-Fort Worth. That's my home base. And that's where I have been for quite some time. I joined Lifestyles Unlimited as a member here in the area. And my wife and I have been buying single-family houses for the past decade. That's retired her. That's retired me. And I know thousands of members that have gone down that very path. Now, we also invest in apartments. Please understand that. Today's conversation will revolve around hard money, which is a tool for buying houses. Granted, if you want to become a small apartment investor on your own, there are hard money type tools out there as well. Think of it as a construction loan or a bridge loan, short-term financing. That's essentially what we're talking about today. But today it will be in the scope of buying those houses. And I'll tell you, 10 years ago when I started, I sat through the 2-day financial freedom seminar whereby we go into buying those houses on the first day and buying apartments in the second. Del Walmsley, the founder of Lifestyles Unlimited, was my teacher back then at the 2-day, my mentor. And despite everything he showed me and everything he taught me, I came away from that chomping at the bit, wanting to go buy some houses. But that last little puzzle piece, that hard money, I was a hardcore skeptic. Because back then, the interest rates, they were 14% on a hard money loan. Are you crazy? Plus origination fees. And who are these guys? Hard money? That sounds scary. It took me a while to get my head around that. That was one of those areas where I needed a nudge, where I needed my mentors to say, look, here's how it works. Here's what you're going to achieve in returns on the back end if you go this route rather than doing 20% down, conventional. And eventually I figured it out, got over that hump, and we've been buying with hard money ever since. It is a great tool. I know it's easy to be a skeptic in the face of the interest rates that they present, but remember, as we go through the discussion today, I'll tell you why that's unimportant. Interest rates now on conventional mortgages are closing in on 5.5%, maybe even 6%. So those are getting up there, aren't they? So speaking of financing, let's talk about some of the different financing types, because you do have options. You do have options depending on what type of property that you are buying. We'll talk about cash. We'll talk about conventional financing. We'll talk about portfolio loans. That's an important one for you if maybe you're a little bit farther down the path as I am. I can no longer do conventional debt. We'll talk about Dscr loans, and then we'll start to talk about that hard money product. We will head into a quick break right now. So when we come back, we're going to dive into those financing types and then get into the hard money, because that's what I want you to take away today, is understanding that is a tool that you need in your toolbox. If you have any questions for me, you can send me an email to askandy@luinc.com, askandy@luinc.com. And we're taking a look at some of the financing tools here in a moment that you may want to put into your toolbox as a real estate investor, specifically as an investor in single-family rental properties. And the crux of the show today is going to focus on hard money. I know when I started investing 10 or so years ago, I had never heard of hard money prior to that. I actually worked in corporate finance. So I worked on the lending side at the corporate level. Hard money, what's that? 14% interest? Oh my gosh, no way. Forget about it. Right? It scared me. But fortunately, I got over that fear, and we've gone on to buy a lot of properties using this very process that we're going to talk about today. Now, to give you an idea of what sort of out-of-pocket you can get on a single-family house, yes, even right now where prices are high, I got an email from one of the Lifestyles Realty team. And if you're in Texas listening, you probably know that Lifestyles was founded in Houston by Del Walmsley over 30 years ago, and it's grown. And it now encompasses all of Texas. That's how I heard about it, was up here in Dallas. I know members down in San Antonio, down in Corpus, and it's now beyond the borders. In fact, we're going to have a guest on later this week who's from Indiana, and he's going to tell us what's going on up there, how that membership base is really growing, what he's doing up there as an ambassador, so you can understand what that means. I'm actually invested in a multifamily property up in Indiana that's already kicking off quarterly dividends. So I'm really excited about that market. So we'll hear more about that. But I got this email from the Lifestyles Realty team out of Tennessee, and I was just floored because it's a tremendously low out of pocket, just about $13,000 to buy a rental property that's going to cash flow around $400 a month. That is, sit down, please sit down. That is a 35.4% return, cash on cash return. While you're watching your stock market kind of wobble, get a little wonky, drop 13.3% to start the first 4 months of the year, down 13%. This house will cash flow 35.4%. So this is why we're talking about real estate. This is why I did the show yesterday telling you how you can really improve your balance sheet, your personal financial statement, just by buying a house. It's going to hit that financial statement in multiple places over your hold period. And part of your tools to help you get into that house, to get into this property, are your financing tools and hard money in particular. Now, let's talk a little bit about the different types of financing that you could use when you're buying a house. Now, first and foremost, we have cash buyers out there. I guess, that's not financing. That's the backside of the paper. That's the alternative to financing. And the cash buyers out there, they think that's very low risk because I don't have to worry about paying that debt. If my tenant gets squirrely or whatever else happens, seems low risk. Here's why it's not low risk. Because now you've put, here, let me look at this Tennessee property. Suggested here, purchase price, $105,000. You've put all $105,000 plus whatever the renovation cost is to fix that up to get. It's now all sitting in that one property. Your risk is highly concentrated right there. Now, if you have $105,000 plus the cash to renovate that property and you go in with hard money, we just heard that your out-of-pocket's about $13K. What if you can do that 10 more times? Now you have 10 properties. You've really diversified. So for the cash buyer, you're actually at higher risk. And essentially you're financing on the back of what we call debt equity. You're just going in and you're accepting the fact that I've now got $150K or so in debt equity in this property. It's getting me a little bit of cash on cash returns. They're going to be far lower than that 35% that we talked about, of course, closer to 5 or 6, I would say. But your risk is actually higher. So we look at financing. And there are different tools when it comes to financing, and these tools will apply depending on a number of things. It depends on where you are from a capital perspective. It depends on where you are in your investment track. If you have enough houses financed, some of these tools no longer apply to you. I'm in that boat, so I have to look at other options. And one of those tools that I can no longer explore that you can is the conventional financing. And when I say conventional, that's a conventional lender that's going to issue a loan that is conforming and that is backed or insured either by Fannie Mae or Freddie Mac. We talked on yesterday's show about Freddie Mac and what the difference between the two is, but that's really where you go to get the cheap money. It's important to understand as well that you can have up to 10 financed properties when we're talking about Fannie Mae or Freddie Mac. Those terms are interchangeable. And for my wife and I, what we did is we were both gainfully employed when we started. Well, we could each do 10. It's not a married couple can do 10. You can each do 10. So I would do one, then she would buy one. Then I would do one, she would buy one. So we kept alternating like that, which was beneficial from a credit score perspective and how we showed our reserves to the lenders as we did the financing. Very important idea there. So you can do up to 10 properties of conventional financing. And when might you do this? Well, this property, they didn't even tell me that that's an option. So it needs enough work that straight conventional is not going to work. You're going to use straight conventional when there's little to no work that needs to be done. You'll also use it when there's no rush to close. Depending on how you source your investment, your leads on these houses, if it's from a wholesaler, for example, or if you're buying from somebody that's headed to the foreclosure steps, I know there aren't many of those right now, but they do exist still. Well, time is of the essence, and conventional lending isn't going to work. So if you've got time on your side, that's a good option. We invested in a new construction recently, out a little bit removed down by Houston because the purchase price was so low. And my wife had one of those Fannie Mae buckets left. We said, let's use it. 20% down, new construction. Now, there wasn't a lot of equity capture, although I'm happy to report that since we contracted and with the build time, the value went up by the time we had our appraisal done. So we did capture a little bit of equity even, but that's not a big equity play. Okay. Another option you might think about with conventional is delayed financing if you do have a lot of cash and you need to get in there quickly and conventional isn't going to work and there's not a lot of work needed. You can pay all cash and then refinance out with something called delayed financing that has to be done within 6 months. If you do any renovations to the property, that money cannot be refinanced out. It's just the initial purchase price. So if there's not a lot of work done, you have to close fast, go in cash, then do delayed financing. Great tactic there. Now, if you've gotten beyond those 10 Fannie Mae buckets, what can you do? What am I looking at? Well, there are things called portfolio loans. And they're called portfolio because the lender that issues that loan, they keep that in their portfolio. And that's typically going to be your local banks, your regional banks. I've got accounts with a couple of different local and regional banks because I need that. I need that tool in my toolbox for potential financing. Now, the interest rate will be a little bit higher, and the terms won't be as favorable. We can't do 30-year term with a 30-year amortization like I can with Fannie Mae. It's probably a 5-year term with maybe a 20-year amortization. What that means is a lower cash flow and a balloon after 5 years. Now, if I'm going to be selling in 3 to 5 years, that's okay. That's okay. But again, terms will be just a little bit different. Hey, we're going to head into a quick break. We're going to talk about one other loan product, and then we're going to get into that hard money, so stick around.
Have you ever wondered what it's like to be a part of Lifestyles Unlimited? Del Walmsley tells you what to expect when you join us for the next live online free workshop.
We've been here for 30 years. Over 30 years, we've had and or do have roughly 50,000 plus members all over the United States. We have retired tens of thousands of people, and it's just incredible what you're going to find that you're going to be in here. Not only are you going to find the greatest amount of information and education, you're going to find the people, the most open people you've ever met in your entire life.
Come meet the people at Lifestyles Unlimited who will help you change your life and empower you to stop depending on a paycheck, your 401k, IRA, or Social Security for your future. Register at lifestylesunlimitedworkshop.com. At the free workshop, we'll teach you the 5 ways to make money with real estate, cash flow, equity capture, appreciation, equity buildup, and the tax advantages. Like Del says, we'll open our books and show you how the numbers work with both single-family and multifamily case studies. Register at lifestylesunlimitedworkshop.com.
Welcome back to the show. I'm your host, Andy Webb. If you have any questions, you can email me at askandy@luinc.com. If you missed any of the earlier part of this show, we're talking today about financing, which is a very important tool for you as a real estate investor. So if you missed any of the earlier segments, go to our website, lifestylesunlimited.com, because the show will be archived there. While you're there, if you're new to Lifestyles Unlimited, if you are new to real estate investing, click on the free workshop button, register for that. It's just an hour and a half of your time. You do it remotely from your computer. It is live. There is a gentleman presenting, and you can ask questions and whatnot. But he'll tell you about the ways we make money with our real estate, how to really double your money with apartment investing. Today we're talking about houses predominantly, but we also invest in apartments at Lifestyles Unlimited, and it's a great option. And they'll tell you how you can get to financial freedom and become real estate retired in 5 years or less. And back to our show on financing, though. We talked in the prior segment about some of the other financing types. There's the cash investor. All cash seems less risky. We talked about why it's not. It's actually higher risk. We talked a little bit about the different conventional lending options there. Portfolio loans, I hit very briefly. That's what you use when you get beyond your 10 financed Fannie Mae or Freddie Mac backed properties. If a little bit of this is going over your head, it's a good time to talk with your lender as well. They can sit down and explain some of this to you in greater detail, or get out to that free workshop that I talked about. Beyond the free workshop, there is our 2-day financial freedom seminar. That's where I learned a lot of this the very first time, and every time that I've gone back. We learn about financing the properties, which is extremely helpful. And the products, they do change over time. So the next one I want to tell you about just briefly, this one's a newer one. It's called a Dscr Loan. Obviously, that's an acronym. Dscr stands for Debt Service Coverage Ratio. And that loan it's not borrower driven. They don't care what your credit score is or what your financial picture looks like. It's purely asset driven. And the asset is intended to be, you wouldn't use this for your personal property. This is for assets for investments that are rental properties. So they're going to look at the cash flow. And does that cash flow have a certain ratio, coverage ratio above the debt service? That's what they want to see. And it's going to vary from lender to lender. Commonly for apartment investing, they want to see 1.25% DSCR, debt service coverage ratio, meaning that the cash flow that property's kicking off covers 125% of the principal and interest on that multifamily asset, just to give you a more concrete example. But that DSCR number is going to vary by lender. But that's a good option if you are beyond your 10 financed properties as well. So that's something I personally am in conversation with lenders about all the time, because I need other tools in my toolbox now. Finally, we get to hard money. And much like DSCR, hard money loans are also asset-backed, meaning the lender is looking at that hard asset, that house that you are investing in. Now, with hard money, it's a little bit different because the lenders will consider you in that bigger picture. They may pull your credit score. They're going to want to see what your reserves are. They'll get a little more detailed, and they also will want to know, going back to the earlier part of the financing segment, they also want to know that you can refinance out of the hard money loan when the repairs are done. So the whole purpose of the hard money loan, or one of the purposes, is to be able to go in and renovate a property that otherwise does not qualify for that conventional financing. So we're going to use this when the condition of the property, let's say, is just too rough for Fannie Mae to approve to insure. If Fannie Mae doesn't want to insure it, that lender's not going to give you a conventional loan. And sometimes too rough isn't very rough at all. It may just be missing the flooring. Maybe the resident pulled the carpet up for whatever reason on the way out. I've seen that. And sometimes the appraisers will flag that. And Fannie Mae says, nope, not interested. Missing a window, not interested. Foundation out of whack, certainly not interested. So we go in with hard money. We do the repairs, make it so that it is desirable to Fannie Mae for her insured financing, and then refinance out. But that lender, that hard money lender, is going to want to know that you can finance out. What does that mean? Do you have the income? Because when Fannie Mae and Freddie Mac are looking at you, the investor, they do look at your pay stubs. So I'm no longer gainfully employed. I no longer have pay stubs. That disqualifies me as well. I guess I'm self-employed. Perhaps tax returns eventually come into the equation, but I have too many loans at this point. So you get the property to where the condition is no longer an issue. You're going to get out of that hard money loan. That is the purpose. It is a bridge loan. It is a construction loan so that you can get in and do the work. So the general process, it looks like this. You go in, you find the asset, you buy with hard money. You fix up the property. Some of the repairs for that property will be financed by that hard money loan. That's the good news. So you go in and you do the repairs, the renovations, and when you're getting towards the end of that, you're going to start the refinance process, and you're going to refinance into that long-term 30-year debt. Now, keep in mind, when I say 30-year, we're not holding that long. But I like that 30-year term with the 30-year amortization, meaning we're paying it down over 30 years because that improves the cash flow for my hold period. Very, very important. The name of the game is cash flow and equity. I want both pieces, and sometimes one's a trade-off for the other, but I want to maximize that cash flow, and we do that by using not a 15-year loan, not a 5-year loan. There are shorter terms, but going for the 30-year note, even if we're just holding it for 3 to 5 years. Now, you may be wondering, when else might I need to use hard money? It's not just if the condition is too rough for conventional lending, but also, like I said earlier in a prior segment, if you have to close fast. And that may be that situation where a wholesaler, they typically, if you're getting leads from wholesalers, and a wholesaler is somebody that contracts a property and sells the contract to me, in essence, they're in a hurry. They're always in a hurry. And pretty much everyone will say cash or hard money. If you want to buy this thing, it's got to be cash or hard money. So if I'm going to buy with a wholesaler, I'm just playing it on hard money. Maybe it's other situation, distressed, seller needs to sell fast. You may not have that middleman. You may be working directly with the seller that's headed towards foreclosure, towards the tax sale because they haven't paid their property taxes in 10 years. Yes, there are people like that out there. Some other issue that is causing them to have a fire sale and they need to close fast. Hard money will do that for you. So we're going to talk about some of the other reasons why, in just a moment, why you would use hard money. It's not just to address the condition or speed of close. I gave you a couple of numbers around a property that I saw from the realty team in Tennessee. I have in front of me here another email. This is from the Lifestyles Unlimited Realty, or Lifestyles Realty in Georgia. So we do have offices in Georgia, in Tennessee, in Phoenix, Arizona, and continually growing. And boy, again, we'll have an investor on shortly that is from Indiana. So we'll hear about that growth outward. But in Georgia, this came from the realty team. Interestingly, same purchase price, $105K. After repair value, when it's fixed up, not a huge spread, $130K. Here's the interesting part. Here's the big why. It's low enough on the renovations that I could go in with a conventional loan. It is on the MLS, meaning it's not a fire sale. It's not a wholesaler thing where I got to go fast. So I could go in with a conventional loan. If I go in with a conventional loan, my out-of-pocket is close to $36,000. Really not too bad in today's market. But if I buy it with hard money, estimated out-of-pocket, $20,000. That's a big difference. Buy with conventional is going to cost you $36K. Buy hard money, even with a double close, even with that higher interest rate at 14% during that hold period under hard money. Just $20K out of pocket. That's a $15,000, $16,000 difference. That's a big why. That's a big why for using hard money. Now, of course, one other financing option I want to throw out there before we head into the break. It's very similar to hard money. Call it private money. Hard money is, in essence, private money. It's not a regulated thing. But when I say private money, I'm thinking about your family. Grandma's got that big old stash of cash that's making a 0.5 point interest in the bank. And maybe she can lend that to you. Talk to your friends. Get out and network. Go to one of the Lifestyles Unlimited case studies. Talk to other investors. Over the years, I've had plenty of investors offer me cash as private money for my investments. Great tool. On today's show, we're talking about financing. We've been talking about financing and financing single-family house purchases, renovations, that whole process that we follow as investors. And we looked at a number of options for you, and those options will apply depending on where you are in your progression, depending on whether you're buying your first house or your 21st house. The numbers vary. The options to you vary. And if you are married, I want to harken back. Remember, you can buy in your own names if you have the right qualifications, debt to income, and so on. Talk with your lender, because if you can peel yourselves apart and each buy your own houses, you can go a lot farther. I'm speaking here from experience. So you can go from that first house to that 21st house with greater ease and with better rates and so on. So I want to talk a little bit now specifically about hard money, because it's a wonderful tool to have in your toolbox. It's a tool that I had trouble getting into my toolbox on day one after sitting through the 2-day financial freedom seminar with Del Walmsley 10 plus years ago. Hung up on the fact that it's high interest, and I was hung up on the fact that, well, if I buy with hard money and then I have to refinance out 2 short months later, I'm closing twice. That's a lot of closing costs. But even with that fact, those 2 facts in place, I just gave you an example of a property in Georgia. I got this from the Lifestyles Realty Georgia team. And if I were to buy this house conventional, because it has lower renovation requirements, it could go straight conventional. I'd be $36,000 out of pocket. If I buy with hard money, that number's $20K. I save $15,000, $16,000 despite a double close. Despite that hard money, that higher interest at holding. Higher interest, by the way, could be, when we started, it was 14%. I think some lenders are still up there. Some lenders nowadays, as you do more investments with them, as they get to know you better, you become a lesser risk. You become a known quantity, and they'll have a tiered program whereby, maybe the first house is at 14 or whatever. Next house maybe is at 12. I'm just pulling numbers out of the air here. I'm not familiar with the programs at that level. You can call around and ask, but let's say then after 3 houses it drops to 9, right? A lot of them offer tiered programs because they're interested in your success. They're interested in having you come back, obviously. And that's one of the reasons why I say you should use hard money. Because your lender is your biggest partner. They do not want to see you fail. They do not want to take back that property. They will if you're not performing, and if they have to. But they are your biggest partner. A couple other reasons why you want to have somebody like that on your team is that, a hard money lender is a little bit different than that Fannie Mae-backed large national lender. Here I sit in Dallas-Fort Worth. There's a little bitty town over towards Fort Worth called Richland Hills. If you're in the Dallas-Fort Worth area, you might have heard of it. I'm not even talking about North Richland Hills. I'm talking about Richland Hills. Population maybe 3,000. Very, very small. That Fannie Mae-backed lender, they don't know what that town is. They've never heard about it. They don't know anything about it. But when I get into conversations with the sales guys, with the team at the sundry hard money lenders here in the area, they know that area. They know that pocket. They know what the city requirements are with respect to permitting. They know the ups and the downs, the pros and the cons. That's a great thing. They know the area, unlike those big conventional lenders. Those guys, what do? They send out an appraiser, and that's all they know, whatever the appraiser tells them. So the hard money lender can give you feedback on the area. And if you're putting together a scope of work, which you will need to do for the hard money process, they'll be able to look at that and tell you whether that's in line with what they see in that market or not, whether it's a good deal or not. I've had a hard money lender, when I was looking at an opportunity very early on, call me and say, Andy, this is not a good investment. Do not do this one. I said, man, I thank you for taking the time to call me. That shows me that you're not just in it for the money. You're in it for my longer term success. I said to the realtor, hey, I'm passing on this one. So these guys are in it for your long term as well. And they'll run the numbers with you. And that's a great thing as well. I run my own numbers, but boy, if I can get a second set of eyes or third set of eyes on that investment before I go into it, those extra eyes on the property, it's extremely helpful. And the good thing is they're with me throughout that initial stabilization period, whereby I've closed. Well, now what am I doing? I'm going through the renovations, and I continually have their eyes on the property. How? Well, I mentioned earlier a repair escrow, because we're going to be fixing up the property. They're going to hold back the repair funds. They're not just going to give that to me. They're not just going to loan that to me. They're going to pay those out as I do the repairs. And in order to pay that out, they're going to send somebody out to take a look at the repairs and make sure they're done, number one, make sure they're done well, number two, which for you means yet another set of eyes on the property. And I've given you two examples today. I'm in Dallas-Fort Worth, Texas. One is in Tennessee, one is in Georgia. I'm not going to be making the drive. As much as I'd like to hitch up my RV, despite the diesel cost, what it is, as high as it is these days, I'm not going to be making that trip to Georgia or to Tennessee to verify that the work is done. I'm going to be relying on these very draw inspectors to help me get through that process. So it comes down to team, and really this lender is the biggest partner on that team as you go through this process at the start. Now, I mentioned earlier that the lender is going to want to see that you are pre-qualified for conventional lending, because as part of the process, yes, you may buy with hard money, but you're going to stay in that debt for as short a period as you can, because yes, it is high interest. Again, the thing that held me up 10 years ago is that 14%. I don't know what they are at now. It varies by lender. You'll have to have that conversation. We're a little bit farther down that track now. We've got the experience. That affects things. But back then it was 14% for me. What I eventually realized is that, well, even though I'm doing a pretty heavy lift on some of these properties, I'm only in the loan for 2 months. So that's 1.10% that I'm paying per month. It works out to be pretty small dollars, and I'm going to be in there for a couple of months, but then I'm going to get out. You don't want to sit in the hard money loans for 12 months, for 18 months, for 24 months. If you're doing that, you're doing something wrong. And then you need to get help. And maybe that means coming to Lifestyles Unlimited. We have a lot of members join that are already investors, that have already bought their first 1, 2, 5, 10 single family houses. And they go to that two-day financial freedom seminar, and they learn a ton. And they talk to our other members at the case studies, and they learn a ton. And they learn how to operate better. So if you are doing this and you're sitting in that hard money loan for 6 months, 8 months, 10 months, you're doing something wrong, and you need to get some help. Go to lifestylesunlimited.com. Go check out the free workshop and learn more there. But you're going to get pre-qualified with your conventional lender first. This is where I wanted to go with that, because your hard money lender wants to know that you can get out of their debt. And typically, if you go and get pre-qualified with that conventional lender, you just need to take that pre-qual letter, say, hey, hard money lender, here you go. And they may have you do some online background stuff, capital, what do you have in the bank, etc. But it's very, very easy to get pre-qualified. And I'll tell you, we have a number of lenders on our vendor hub. If you are a member of Lifestyles Unlimited, you can go to the vendor hub and just go look at all the hard money lenders. Type in your state, type in your city, look for hard money. And I had a listener, in fact, ask me the other day, well, which one should I use? Well, I don't know. I can't really tell you that, because you're in a different market and you have a different personality than I do. Ultimately, you're going to want to go out to that vendor hub and look at all the lenders. And there are peer reviews on there, so you can see how other people have rated that lender. And do they have 5 stars out of 5, or do they have 3 out of 5? If so, why? and start to call around and talk to at least 3, maybe more, and see which one best fits your personality. Because again, this lender is your biggest partner. So you want to make sure it's a good fit. Some people, you're just going to clash. Move on to the next one. Find out which one really fits you best. So we talked about why using a hard money lender, because you can close fast and you can address the condition of the property. We talked about the lower out of pocket. Again, I've stressed this with the Georgia investment opportunity. I saw conventional lending. So with the conventional loan, I'm just going to pay 20% of that 105 purchase, and then I'm going to have to fund the renovations out of pocket. That's really going to push my out of pocket up. That's why we're landing at $36,000. Just the 20% down puts you at 21, plus closing, plus rehab. With the hard money, even though there are double closes, we're coming in with a much lower out of pocket. In this particular example, the cash flow, now you have to keep in mind when you do the hard money purchase, your loan amount on the back end is actually higher. So your cash flow will decline a little bit, but your return goes up because you have so much less money in the investment. Very, very important. And it's that lesser cash into that investment that then allows you to go on to the next one, and then the next one after that. So if you're able to get into a property using hard money and cash flow $300 and get into the next one, cash flowing $300, now you're at $600. And the next one at, let's say, $400, now you're at $1,000. Compared to that cash buyer that put it all in one, they're not paying a mortgage, so their cash flow is inherently a little bit higher, but they're not making money 5 different ways across all that portfolio of houses that you've now been able to invest in. And that's the key. And that ties back to the show yesterday on the personal financial statement. You put more of these assets into play and you start to grow that net worth much, much faster thanks to multiple streams of cash flow, thanks to getting that equity capture on multiple properties, thanks to the equity buildup by way of your residents paying down that mortgage on multiple properties. And don't forget about appreciation that's pushing up the value of not just one, but 3, 5, 10. Wash, rinse, and repeat. Hey, go check out lifestylesunlimited.com. We'll be back with more content for you, so tune in. Thank you for listening. You have a good day.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.